Once you identify MOAT in the business, the next consideration is management performance. You might question how the average investor can assess an executive team's competence. It might sound like a difficult task. However, it's not that complicated when you follow the structured approach. In this session, I will introduce you to the framework to analyze company management. Warren Buffett believes, the quality of company management is key factor on whether stock will be a good investment over long term. Evaluating management performance is critical component of analyzing stock. You should look for management team that act like shareholders, rather than hired hands. Let's try to understand what are the traits of a good management and how to perform management analysis. Within 3M investing framework, the second M stands for management. The management analysis process is divided into two distinct categories: qualitative analysis and quantitative analysis. There are certain critical factors that investors should use to differentiate a good management from a mediocre. We divide qualitative analysis into three distinct sections. The first part focuses on assessing management quality through well-defined checklist. Checklist is one of the simplest and quickest way to analyze management quality and risks in the investing. The checklist has predefined questions which helps in management analysis and list down positive and negative traits. The second important management characteristic is owner-oriented approach. Owner-oriented means, company management and CEO have their personal interest directly aligned with the shareholders of the business. When management has majority of their personal wealth invested into the company, their decisions will be long-term oriented, benefiting the stock in future. On the other side, if management has heavy stock options as compensation, they are enticed to take decisions that will benefit stock in the short run so that they can exercise options. The next consideration is management capital allocation decisions. Shareholder-friendly companies typically require managers and executives to act in the interest of common shareholders when it comes to deploying free cash flow. Company has mainly 5 options to leverage free cash flow generated by business. These options mainly include acquisition of other business, reinvestment in existing business to drive growth, debt reduction, dividend to the shareholders, or stocks buybacks to reduce outstanding shares and boost earnings per share. Please remember, two companies with the same operating profile can drive very different results for shareholders over long term depending on what options CEO and management chose for reinvestment of free cash flow. Hence, this is the single most important factor to drive future growth. Once you perform qualitative analysis of company management and it passes our desired expectations, this will certainly show up in the key financial metrics. From quantitative analysis perspective, we prefer to look at 4 important ratios and ensure management performance is reflected in the key financial metrics. These numbers are the proof of strong business management. The stock investor must look out for an honest management with great track record of corporate governance. I will explain management analysis framework over next few sessions. This should help you to understand the traits of good management. Thank you.